Lorraine and Rowena cannot make it. So first thing, we'll vote on the minutes of our February meeting. Ask for a motion to approve.
So moved.
Second? I'll second. All in favor?
Aye.
Okay, then we'd like to go into executive session pursuant to the Connecticut General Statutes.
I'll make that motion.
Okay, there's a motion to go into executive session. I'll second it.
Okay, so in terms of inviting, who we're inviting into executive session, we'll have Attorney Gabe Duran from Shipman and Goodwin, our actuaries from Milliman, and Paul Tracy, who's online, and that will be it.
Okay, we're back in public session, open meeting, and we'll turn over to Carl for a proposed proposal.
I'd like to make a motion, an addendum to the Town of Old Saybrook retirement plan that states, notwithstanding any provision of the plan to the contrary, the normal retirement benefit for the police participant. I'll give this to you, Chrissy, after.
Okay.
Who terminates employment with the Town of Old Saybrook on September 1, 2025, in accordance with the separation agreement with the Town of Old Saybrook, shall be determined based on 35 years of credited service and dated the 27th of March, 2025. I'll make that motion.
But the motion should be that we
Are recommending that, yes,
the Board of Selectmen
that's
approve
correct.
this.
Recommending to the Board of Selectmen that addendum. That's correct.
I'll second the motion.
Thank you for the correction.
Any further discussion? Ready to vote? All those in favor, aye?
Aye.
Any opposed? Any abstain? Okay, it's passed. Thank you.
Thank you, Mr. Chairman. Thank you to the Pension Board.
Okay. And you can turn over to you, Becky. Annual. This is something that we do. I know this is your first time here, but every year.
I heard last year.
Okay. It's been a while. Okay, that's good.
I brought along paper copies. I know you got electronic copies of the presentation, but if anyone would like paper notes, you mind?
Yeah, please.
Let me also, we have two, one for each plan. Yeah, that's
This is five, this is 10. This is 10. I do print something like
Yes.
this.
Oh, you guys are awesome. Right, so, good morning, it's good to see everyone, and I think everyone was here earlier when I introduced Melissa. I would have liked to have brought more of the team here to meet you, but Melissa is conveniently located nearby, and you do start at 8:30 in the morning, so yes. Every July 1st, we prepare evaluation of the town pension plan. And I want to start with that. In odd numbered years, we also prepare evaluation of the fire plan. But this year, we have done a special evaluation of the fire plan. So I also have fire plan results to share with you. But I thought we'd start with the town plan, and then the fire conversation, I'll just skip to the key parts. So we'll spend the bulk of our time with the town plan. And I am here to give you a bunch of numbers, but also to make sure you feel comfortable, equipped with an understanding of the actuarial stuff, so that you're the ones who make decisions about the pension plan. So please don't hesitate to ask me questions as we go along. If there's anything I say that isn't clear, please stop me and because I'm here to make sure that you feel comfortable with everything we're saying. You may notice that we've got an updated look and feel of our materials, which we hope you will find helpful. And in particular, on the very first page, we have some key takeaways. So after we go through those three things, you can stop paying attention. If a concerned citizen stops you on the street and asks about the pension plan, these are kind of the three things you need to know. The investments did well. The funded ratio declined a little bit, but for reasons that had to do with that third bullet, which was that there were changes adopted that improved benefits for police members. So liability went up and the funded ratio came down just a little bit. And then the fourth thing, when I went over these results with Leanne Palladino, we chatted with the notion of potentially changing the amortization growth rate, and I will talk about that at the very end. But so what I'm planning to do is start with liability, which is based on the information we get from the town each year with respect to the people who are covered by the plan as of last July 1st. Then we'll talk about the investments with respect to how they impact our calculations. Then we'll end with talking about the contribution, how the assets and liabilities put together give us some conclusions about how much the town should contribute to the plan. Okay. So turning to page 1 here, this is in brief picture of the plan's membership as of July 1st. At the top left, we have a graph that shows how the number of members has changed over the last 5 years. We separate all of this membership information and we've color coded it, and my apologies in advance if anyone has any color deficiencies and the color coding isn't working for you. There's 3 different groups of members of the plan. At the bottom of this historical graph are the active members, the people who are working for the town and continuing to earn benefits. And that includes some employees at the Board of Education, employees of the police department, and some employees here at the town. It's been a dwindling number of members because in 2017, the plan was closed to Board of Education employees, town dispatchers, supervisors, and support staff. So those people who terminate employment or retire are being replaced by new employees who are covered by the town's defined contribution plan. So we have a dwindling number of active members. Meanwhile, we have a growing number of members in pay status. Those are people who have retired, they're collecting a monthly pension check. And then we have a small number of people who are called terminated members. They used to work here, they don't anymore. They are due a benefit, but they haven't started collecting benefits. So in the fullness of time, those terminated members will start receiving their benefits. The rest of the page just provides a little bit more information of makeup of each of those 3 classes of people. From 2023 to 2024, you'll see the number of active members went down from 72 to 63. 6 of those active members retired. 5 of the active members terminated and received a refund of those member contributions. The number of retirements was about what we expected. What was unexpected is that a couple of them retired at very young ages. Some people retire the moment they first can. Some people retire at key ages like 65 or 62. Some people retire when a spouse retires. Some people stay on working here till they're 80, right? You can't dynamite them out of their desks. So there's a spectrum of retirement behavior, and we have an assumption about when people are likely to retire, and the assumption does not include an expectation that many people will retire at very young ages. So this was unexpected that there were 2 members that retired pretty much the moment they were first eligible to. That caused the liability to go up more than expected. It was just an unexpected thing. We had more than the expected number of the active members terminate and receive a refund. So that was actually a reduction in liability. And those two things more or less offset one another. We ended up back where we started. 2 of the retirees passed away during the year. That's about on par for what we expected. Down in the bottom with the active membership, one of the things that impacts the liability for active members is how much they're being paid. So we keep a close eye on unexpected changes in compensation. We always send a list back to Janet of, can you confirm that these compensation changes are correct? By and large, people's compensation changed about the way we expected, but there were a couple of individuals, just I think isolated situations where pay went up more than expected. And that could be promotions. It could be someone was on a leave of absence the prior year and then came back, or someone had a change in their scheduled hours, things like that. So the compensation for a couple of individuals just moved up a little higher than expected. So that also was a source of the liability moving up a little bit more than expected. Any questions on the membership?
Straightforward.
Okay.
Thank you.
Next page then is the investment information. And in the top left, we have again the history of the investment returns. This was another nice good year. 11.11. It's very, very nice and neat number, I have to say. So another nice year. I'll take low double digits. You know, yeah, every now and then you can have a 20% return or a negative 20% return. I kind of like the steady Eddie because then the contribution numbers don't swing much, but a nice year. That's sort of what a lot of our clients, the Connecticut municipal pension plans experienced low double digits. The 2 years in a row of nice returns. Of course, the year before that was negative 14%, and the year before that was 28%. Those ups and downs are typical. You have a strong, robust investment portfolio, and it is going to generate some years where you have really good years and sometimes when they're really bad years. We don't want that volatility in the investment returns to cause a lot of volatility in the town's contribution. So the weapon that we wield to try and shield the town's operating budget from investment volatility is to smooth investment gains or losses over a 5-year period. And you can see that down in the lower left where we are showing the market value of assets, the money that you actually have in the plan. Those are the darker green bars on the left-hand side. And then the lighter green bars on the right-hand side are the actuarial value of assets. That's just a number we determine. It's not money in the bank, but it gradually recognizes any gains or losses over a 5-year period. And you can see as you go from 1 year to the next in this last 5 years that the market value has moved around a fair amount. It went up a lot, it went down a lot, and now it's come back up a bit. Whereas the actuarial value of assets has moved much more steadily and in fact has moved steadily up. At July 1, 2024, the market value and actuarial value are almost identical. That just means that over the past 5 years, you've had about the same amount of gains as losses. And you can see that in the upper graph, we show the compound annual return over the 5 years is 6.73%, which is almost right on the nose with your 6.75% interest rate assumption. So that can give you some comfort that 6.75 is a good interest rate assumption. Questions about that, about the investment performance or the assets moving? Okay, and on to the next page. This is the analysis we update every year to help you feel comfortable that your interest rate assumption is appropriate. The current interest rate assumption is 6.75%, as I said. The graph on the top is just a pictorial representation of your target portfolio. You have a variety of fixed income, which we've shown in green, and equities, which we've shown in blues. And we've charted them. The size of each bubble represents how much of the portfolio you have in that asset class. And then we've placed them from top to bottom and from left to right based on the expected annual returns, that's the top to bottom, and the riskiness, the volatility of those returns from left to right. So your fixed income is low and to the left, lower earning, lower volatility. Your equities are further up and to the right, higher expected returns, but also more likely for those returns to swing about more from one year to the next.
So this is our target portfolio distribution.
Yes.
Is the risk assessment Milliman's
Yes.
or Morgan?
So this is ours. This is based on Milliman's capital market assumptions, and Kevin will have a somewhat different take on this, looking at somewhat different data and maybe a somewhat different time horizon. We look at a very long time horizon because we're looking in the context of a pension plan, which has a very long time horizon. We update this analysis every year, so this isn't static. And in fact, some of this information gets put in the pension footnote in the town's annual financial statement. The key figure we look at when we look out at the expected returns over a 30-year period, so we're looking in the lower graph at the far right-hand side, we look at that 50th percentile number, that the average return, if you will. There's a range of potential returns. We look at the middle, the 50th percentile. And this year, our result is 7%. A year ago, it was 6.9%. The year before that, it was 6.9%, somewhat higher than your 6.75% assumption. If we rewind back before the war in Ukraine started, when interest rates were much lower, when inflation was much lower, this analysis was yielding numbers like 6.4%, 6.3%. It's higher now because inflation is running higher, because interest rates are running higher. So what I've been telling you for the past 3 years is, for the time being, 6.75% is fine. In fact, if anything, it's a little conservative. If and when interest rates and inflation go back to the pre-war levels, we may well get back to results from this analysis that indicate that the interest rate assumption should go down. But for the time being, I am very comfortable staying with 6.75. We will update our analysis every year. We're now in March. I'm pretty sure that by the time we get to June 30 of this year, we'll still be looking like there are no signs that interest rates and inflation are going to come down anytime real soon. But it is the Fed's stated policy to work towards that goal. So the time may come when we come back and say, you know, we need to think about reducing the 6.75. But at this point, there may be a chance we come back and say, hey, you know, maybe we should be talking about 7. So that's where we are right now. That's the most important assumption that we build into our analysis, though. So I always want to spend a little bit of time talking it over, making sure you're comfortable with where we are. Okay. All right. Then turning to page 4. Here's where we put liability information together with asset information. But let me start with liabilities, which are the 2 graphs on the top. The 2 graphs on the top are showing exactly the same liability. The graph on the left just shows it in total. The graph on the right shows it broken down by those 3 classes of active members. You can see that the liability's gone up from 32 million last year to 33.2 million. We expected that the liability would go up ever so slightly. Liability goes up over time because you have more active members continuing to earn benefits, adding to liability. We measured the liability prior to reflecting the plan changes that were implemented. And that liability number came in almost exactly. We expected 32.55 million we measured 32.59 million. So they're virtually right on the nose. There were a couple of things I mentioned earlier, that people retiring at very young ages, but more turnover than expected, a couple of people with compensation increases. They almost entirely offset one another.
Okay.
But we had then the plan changes that were implemented for police members. And there were 3 changes. One is that the retirement eligibility was the earlier of age 60 or 25 years of service. That 25 years got moved down to 23 years. The second change is that pensionable earnings now includes additional compensation like overtime, but not private duty pay. But that's capped at 112% of base pay. So there's a limit to how much overtime will flow into pension benefits. And then those both increase liability. There is also an offsetting increase in the employee contributions that police members make. It was at 5%. It's gone up to 6% this year. It'll go up to 7% next year, 8% the year after that. So in effect, the active police members are paying for a portion of the cost of the benefit improvements. But the benefit improvements increased liability. We were at 32.59 million of liability before these plan changes were measured. The final number is 33.2, so a modest increase. I moved it down on another page. $560,000 increase in the liability for those plan changes. The 2 charts on the bottom compare the liability to the actuarial value of assets, the dollar difference on the left-hand side and the ratio of those 2 numbers on the right-hand side. The unfunded accrued liability actually had gone down slightly from 4.7 million to 4.6 million before we reflected the impact of the plan changes. So now instead it's gone up to 5.2 million. And similarly, the funded ratio was at 85.9%. So modest improvement. Good year in the investments. Liabilities were right on target. So things improved modestly. And then you had the plan changes that brought things down modestly.
The question I always had there is how does that 84% compare to others in the state?
You're solidly in the better than average category. There are some plans that are in Connecticut that are funded in the 90%. There are 1 or 2 that are overfunded. But mid 80s is very comfortably sort of better than average.
Okay.
Other questions? All right, and then turning to page 5, now we translate this into what the town should contribute each year to ensure there's enough money to pay benefits. And again, we have the 2 graphs show exactly the same amounts. The graph on top just breaks the contribution down into the 3 component parts. The normal cost in the dark green, the cost of the benefits being earned each year by the active members, offset by the amount that the active members are contributing towards the cost of their benefits. The normal cost also includes a component to reflect administrative expenses that you pay out of the plan's investments. Then the lighter green number, the past service cost, is a payment to gradually fully fund the unfunded accrued liability. We're down to a 15 years left in that payment schedule. And then on top, the little orange numbers are 1 year's worth of interest, because we've measured all of this as of July 1, 2024, but we are calculating the town's contribution for fiscal year 25-26. So we add in a year's worth of interest to reflect that 1 year lag. And you can see the total then down in the bottom at 834,181. That's up about $80,000 from the prior fiscal year. It would actually have declined a little bit to about 750,000 if those plan changes hadn't occurred. The 834 also reflects a change. This is a decision in front of you, a decision that Leanne and I discussed of potentially changing the amortization growth rate. I want to walk you through, and in fact, we could turn to page 6, which I know lots of people like the pretty chart, but some people want to see the numbers. So page 6 is that page with all of the numbers. You can see on the left-hand side, I've just repeated the numbers from last year's valuation for comparison, and then the 2024 valuation. We have 3 sets of numbers. Prior to making any changes, the middle column reflects the plan changes that were bargained, and then the right-hand column, which is headed lower amortization growth rate, is for your consideration. You have an unfunded accrued liability of $5.1 million. We're down, as I said, to 15 years remaining on the payment schedule. Right now, the payments are determined using a 3% growth rate, meaning by design, that component of the contribution will grow by 3% a year, which is fine. That's building in, though, for the town's future contributions, that component of the contribution will grow by 3% a year. And if you bring down that growth rate a little bit, it will increase this year's contribution. So with 3%, you have a lower contribution this year, but it will grow more quickly over the next 15 years, as opposed to a somewhat higher number this year that will grow more slowly and therefore put less pressure on future operating budgets. So this is a question of financing, of the pattern of contributions over the next 15 years. So it's a budgeting question. Either way, regardless of the amortization growth rate, this schedule puts you on a path to being fully funded in 15 years. This is merely a question of how you incur those costs over the next 15 years. You could have a 0 amortization growth rate. So it would be just like a mortgage. You pay the same, the town would pay the same amount every year. So it is a question of financing. Leanne asked me to kick the tires on what it would look like if you move the amortization growth rate down to 2.75 or 2.5%. So modest reductions. I've just illustrated the 2.5% numbers here. You can see the actuarially determined contribution is 819,700 with the current 3%, that's the middle column, and it goes up to 834,000 if the amortization growth rate is lowered to 2.5. If you went to 2.75, the number is exactly halfway in between. It's just a linear.
And I think she's planning on the 834 in the budget,
In the budget,
is what she has in there.
right. I think the protocol, but you know better, is that this board, I don't know, makes a recommendation to the Board of Finance or adopts. I'm trying to remember last time we changed assumptions. Do you adopt that change or recommend it?
I think we recommend it. I mean, we don't adopt anything. I recommend it to the Board of Finance.
Okay.
So that's the thing we need to vote on, I think.
That's correct. That's correct, Paul. Daryl.
Okay. Who was that, Carl?
Yeah.
Carl. So I think I'll make a motion that we recommend to the Board of Finance that the amortization growth rate be changed from 3% to 2.5%. That's a motion.
Second.
Second. Any discussion, questions on that? Okay, the vote, all those in favor? Aye. Any opposed? Any abstain? Okay, pass.
Okay, then we will go ahead and issue our valuation report with those numbers.
Good.
Okay,
Well done, thank you.
Any other questions on the town plan before we move to the fire plan?
Anyone?
Okay, then the other, so this is an identical packet, except that some of the numbers and words are different. And the key takeaways are a little bit different. In particular, as I said at the outset, we wouldn't normally have done anything for the fire plan this year because this is 2024 is off cycle. But there were significant plan improvements that the town adopted, increasing the basis for determining benefits. And so I talked this over with Leanne and we concluded that it would be appropriate for us to prepare what we call an interim valuation. So we skipped some of the time-consuming parts of the evaluation process, which is getting updated member information from the police department and Janet. But we have reflected the plan changes and the actual investment performance. So it's not a complete remeasurement on July 24, but we've captured the key moving parts, which is a good year of investment performance and the plan changes. And some of the plan changes, so it is the benefit multiplier was increased from $270 to $335. That's reflecting inflation from 2014 through 2022. There's an extra bit of benefit that gets paid to people who serve as an officer for a period of years, and the officer benefit amounts were increased by 50%. I think they have not been changed in a long time, so they were increased. And there are a number of members who, they're active members of the fire department, but they are old enough that they are also collecting a pension benefit. So we did reflect that their benefits went up. There is a little bit of noise of things that we didn't reflect that we will pick up in the July 2025 valuation. We'll be back on schedule to the extent any individuals receive retroactive benefit increases. We'll pick that up when we do the 2025 valuation. But this really kind of reflects the major stuff. And if you like, most of the conversation really is exactly the same as with the town plan. We could just go to page 6 and look at the numbers. And I realized yesterday, as I was annotating my own copy, I've scribbled all over it, that you should ignore the 2023 numbers on the left-hand column because they're the wrong numbers. My apologies for that. But the key things that with the 2024 valuation, we've done a quick before and after. What would the numbers have looked like with no changes to the benefits? And then we've measured the impact of increase in the benefit multiplier, the officer incentives. And you can see that the contribution has gone up from 209,000 to 270,000. Now here again, we have a 3% amortization growth rate. And I think it would be sensible for you to consider lowering the amortization growth rate for this plan as well. That would increase the contribution to 276, 476. And I didn't include that on this.
If we went to 2.5?
If you went to 2.5.
Yeah.
So it's just, it's not even $6,000 of an increase in the contribution.
Okay. I guess I would make a motion there that we recommend to the Board of Selectmen that they change the amortization growth rate from 3% to 2.5%.
Second.
Second. Questions, concerns? All in favor, aye?
Aye.
Aye. Any opposed? Okay, thank you.
Okay, I skipped over all the detail with the fire
That's good.
numbers,
That's fine.
but I think
Appreciate that.
you had what
We got a lot of stuff to go through today. so-
Right. Any other questions or concerns for us?
No, well done, well presented, thank you.
Okay, well, it's been
Appreciate
good
it.
seeing you. We are going to take off and
Okay.
start working on those reports for you.
Thank you. Thank you very much. Okay, Janet.
please.
All right. Right. For our March pension gross payroll, the town PD Board of Ed had 99 retirees. Our gross payroll was $161,556. We had one retiree pass away in January. Dick Adoody was a retired dispatcher with 12 years of service. We still have one QDRO spouse for a total of 100 participants. For our fire department, we have 37 retirees. Our gross payroll for March was $16,344. There's no change in the number of retirees for the fire department. We have one QDRO spouse for a total of 38 participants. We do have a few pending retirements, 3 in the fire department. Michael O'Neill will start his pension next week. He has 22 years of service with the fire department. Robert Vanderhorst will retire in June with 10 years of service, and past chief Vernon Scow will retire early in June with 28 years of service. We also may have, very likely to have 2 more retirements this summer. 2 Board of Ed employees have been in touch with me. For our current defined benefit and defined contribution plan numbers, as of our last payroll on March 14th, our DB plan has 45 contributing employees from the town and 20 contributing employees from the Board of Ed. Defined contribution retirement plan has 43 town employees and 29 Board of Ed employees. And a total of 76% of those are opting the additional 3% match. And that breaks down to 88% for town employees and 59% for Board of Ed employees. That's it for March.
Any questions for Janet? Okay, Kevin.
Slides, we'll start on page 5. So, a lot of changing forces going on in the market right now. Basically, the market is kind of flat since the election, but there's been a lot of change in terms of the leadership that we've had. So we're just going to bring up the market slides. There we go. So we go to page 5. There we go. So you can see, markets had a tougher time obviously this year. A lot of reasons that, tariffs on, tariffs off. We've kind of talked about that. The 10-year treasury roll has really done a round trip here. This is like the second time that it's done this, right? So we just continue to see a lot of volatility in the 10-year treasury because it did this before, if you remember, in 23, went all the way up to 5%, back down to 3.8%. Now we've seen it bottom out at 4.2, up to 4.8, back down to 4.2. If you want to go to page 6, this is the change in leadership. I was talking on the left-hand side that every single one of the Magnificent Seven is negative for the year. And you can see here that the Magnificent Seven is falling much faster than the rest of the market. So there's been a complete rotation from growth and tech back into more blue chip and value sectors of the market. We'll go back to, let's see, page 10. One thing that the tariffs and I'd say lack of kind of policy direction from Washington is causing is on the right hand side. You can see small businesses are very uncertain about what is going to happen going forward, especially in regards to the tariffs. But basically, you can see kind of when this sort of peaks out, it generally coincides with more difficult markets on the downside, right? Late 1990s, 2008, going into 2020, and then of course at a high, in terms of since they started tracking this over the last 40 years. Page 13. So, we talked about this sort of the last, I'd say, 2+ years. The equity markets are begging the Fed to cut rates, right? It's not going to happen. Morgan Stanley really thinks we're going to see one Fed rate cut in June. Inflation has come down. It's almost close to actually where the Fed's kind of target range of 2% is. The problem is that, the impacts of the tariffs and the lack is yet to be, and the unemployment, especially in Washington, is yet to be seen, affected in the numbers. So they're very well aware of this. So again, I'm just going to go back to, in the lack of a severe recession, I don't see the Fed acting, too aggressively here in terms of cutting rates because they see what's coming down the pipeline. In terms of policy, page 17, just quickly. So, one of the things that happened during the first regime, under Trump was it was a strong market and ended up being very, very strong, but it really didn't get strong until basically the very, very beginning of his term and the very, very end of his term. Beyond that, we're pretty much range bound. And don't forget, his main, trade war concern was China, only China, really, at that time. Now we've got Canada, Mexico, Europe. You name it. Every other day, there's some other trading partner that he's threatening tariffs with. So I think it could be a little bit, choppier as we kind of move forward here. Page 24. Quickly, equity risk premium still kind of around flat. It's bounced up a teeny bit here. That's because the price to earnings ratio, if you go to the next page, on the S&P 500 has fallen from basically 23 to 21. Still very, very expensive, okay, in terms of relative to history. History is around 15, 16 times. It's really just in the last few years that we've seen it much above trend line for that. And when we look at page 29, there's a lot of optimism about deregulation, about, lower taxes, what this could actually mean to earnings and earnings growth in the corporate sector. Just keep in mind that we're at record high margins already, okay, in the S&P 500. And that, basically one of the things that I think we're a little concerned about, and Morgan Stanley still has a $6,500 target next 12 months in the S&P 500. So expecting it basically be flat for the year, but certainly up from where it is right now, is if you put a 15 multiple on a $300 earnings, okay, which is basically sort of where we're trending to, that's 4,500 on the S&P 500. That's if we trend back to normal, normal PE ratios. And again, I just want to point out, we were last at 4,500 in October of 2023. Okay, so things have gone up. I think I showed you in, January, 20 to 25% of the return over the last 2 years has simply been because people are willing to pay more for the dollar earnings, multiple expansion. So we feel like there's been a real shift back to fundamentals here in the market. And that is resulted in our positioning. And one of the things that I want to kind of point out, given Becky's presentation is, especially in the town pension with liabilities that are going to be increasing now, that's going to put more of a reliance on the cash flow that we're receiving from the pension to pay those liabilities. And also would, I think, reinforce our, more defensive positioning so that we can be more protective in bad markets, because we're still going to have to pay out higher liabilities going forward. And when you're in a paying, pension like we are right now, where cash flows are negative, we have to pay those regardless of whether the market's up, down, sideways. And so just bad markets have a worse return on your money weighted return of what actually happens to the portfolio than good markets do, right? Any questions, thoughts? I'll hand it over to Becky, who will go over the performance. And just want to say, we did this, took a look at this yesterday, and just want to, month to date for March, as of yesterday, you're down 1.13%. That's versus the IPS at 1.77, so 60 basis points of outperformance to the downside, and the 60-40 at 269. That's 150 basis points of outperformance. So protecting better than downside so far.
Yeah. So if we just start on the top left-hand corner, you can see at the end of the of February. The valuation for the pension was 28,417,000. So for, Kevin kind of updated what the quarter numbers were, but for the custom period, gross of fees was 6.43%, net of fees 5.94%. If we just go back and do a little look at the last 5 years, our gross fees of 8.61% and last 10 years is 7.01%. Did beat the IPS benchmark as well as the 60/40 in terms of the, not the 60/40 for those 2 time periods, but did meet the benchmark. So interesting to look at. But if you look at the custom period, kind of not too far beyond that and making up as the year has gone by.
I just want to point out too,
Yeah.
higher than the actuarial assumed rate of return, which is what we're trying to target as well. So happy to see that. So,
Yeah, that's okay. This chart reflects the 5-year numbers that we were just looking at. So the portfolio, this is net of fees. So this is 7.83%, very, very close to the IPS benchmark as well as the 60/40. And then if we go here to the time weighted performance, we can see it's actually really interesting if you look at the 5 years. That does include the, I can't seem to get this other piece off the page here, but if you do look at the past 5 years, that does include March of 2020. So when you look at the end of the year for the next report, which will be the end of March, that, the rebound of the COVID crisis will be in the numbers. So just kind of a little interesting aside there. But year to date, portfolio is doing very well. Beating also, the IPS benchmark as well as the 60/40. It's also interesting to note if you were to look at the EFA, so that's a couple rows down here. So year to date, the MSCI EVA is, doing much better than everything else in that column, so it's 7.3%.
Mr. Chairman, we need to stop at this point, so there needs to be getting, so.
You're not coming through clear, Carl. Can you repeat that? Carl? No. You may have been talking to somebody else.
We'll skip on down to, town pension for the percentage terms. This is for the last 3 months. So as of the end of February. And again, you can see the outperformance of the international developed markets, basically relative to everything else, particularly US equities. And then if you look at the manager performance, everything is holding in line. The 2 that have not performed as well as the others has been the John Hancock Large Cap Core. That probably has to do with the exposure to the tech. And then also, the EM has done a little bit poorly, but if you were to look at the custom period at 6.65%, held in very, very well compared to the benchmark there.
Would you discuss the Kane Anderson mid-cap?
yeah, so, I think, we made a change, right, from Nuance mid-cap to Kane Anderson, basically, last year. You can see, the underperformance, I feel like, has to do, one, sort of the timing when we actually implemented them. It was at the end of a month. I think that mid-caps had a pretty, strong month, basically in in March, if I remember correctly. But their positioning is gonna be a little bit more, balanced. Nuance was very put on the, the value side. Mid caps had a really, I'd say, a tougher time than expected. And that's because a lot of these mid cap companies, unfortunately, are exposed to, I'd say, materials that basically are gonna have now tariffs possibly put on them. So that's going to put pressure on their, their kind of their expenses going forward. But you can kind of see, I'd say, year to date and month to date, certainly hanging in there at the benchmark, but severely lagging. And after, I think it's mostly due with stock selection as opposed to, value growth weighting. But we've only had them for a year, and I think we should, give them at least a 3-year time period before we start making any changes.
Okay.
We could just quickly touch on page 16, which just shows our asset allocation versus the target, where is basically we're almost right on target. So very close on the asset allocation side. And then the last piece, just to look at the fixed income. So we have increased duration. You can see the blue bar charts on the left-hand side for the fixed income portfolio. And if you just take a quick look at all the bond holdings, so on the yield to maturity, we have 5.13%. So really good with a modified duration of 2.84. So again, kind of taking advantage of where the interest rates have been on the short-term end of the curve, and starting to edge out a little bit on the duration.
Yeah, almost a 3 on the duration and the portfolio, and still a yield of over 5. So, basically about a year ago, we were closer to 2 on the lower end. So we continue to move more money towards, I'd say, intermediate maturity, duration, and try to become a little bit more neutral. And you can kind of see that if you go back to the manager page of the fixed income, which is basically on page 12. We have about, just over 3 million in each of the intermediate maturity bond manager, Boyd Watterson, and 3 million in the parametric short-term corporate bond. Trying to be a little bit more, I'd say, duration neutral, but still need a little bit of ways to go, because once those, short-term bonds roll off, and then they invest in higher duration bonds that are going to be 4 to 5 years now, you'll see the duration continue to creep up.
Last page we can touch on is just the income expected for the year. So we're at almost 700,000 of income, projected 12-month income. So again, kind of mentioned earlier in the, for the presentations of the day, stabilizing attributes of having all that income coming in.
And we'll do the cash flow analysis in conjunction with the final actuarial evaluation that Becky puts out, and have that later in the year.
Okay, questions, comments?
Holding steady with the portfolio, we think it's protecting the downside, we think it's doing a good job. And our overweights are, international, especially in fixed income even, are starting to, help mitigate portfolio volatility.
Okay. So hang on and see what tariffs are doing today.
I mean, it's amazing if it's like, when Trump doesn't speak, the markets go up. When Trump speaks, the markets go down, and that's because he's usually talking about tariffs, not about anything else about him. Mostly just because he's, threatening a global economy that seems to be functioning pretty well right now, so.
Okay, thank you. Anything else? No new business, any old business, nothing? Okay, motion to adjourn?
Second.
All in favor? Aye.
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 See you on the 24th of April.
Great.